Right now, as you're watching this, your money is silently losing value, and most people don't even realize it because what's happening isn't just inflation. It's a chain reaction, war, oil, and decisions being made behind closed doors that will reshape your financial future. Let me explain something in simple terms. When conflict rises anywhere in the world, the first thing it touches is energy. Oil prices spike, transportation costs rise, food, manufacturing, daily essentials, everything becomes more expensive. If you want to stay ahead of what's coming and not become a victim of it, make sure you pay close attention to the rest of this and start thinking differently about where your money sits. War has always been one of the most powerful disruptors of global stability, and its first major impact is on supply chains. Modern economies are deeply interconnected, relying on a constant flow of goods, raw materials, and energy across borders. When conflict erupts, these connections begin to break down. Trade routes become unsafe, shipping costs rise sharply, and key transit points may be blocked or restricted. This creates immediate delays in the movement of essential goods such as oil, food, metals, and manufactured components. As uncertainty spreads, businesses struggle to plan ahead. Companies that depend on just-in-time inventory systems suddenly face shortages, forcing them to either halt production or pay significantly higher prices to secure limited supplies. This cost pressure doesn't stay confined to corporations. It passes directly to consumers through higher prices on everyday items. At the same time, financial markets react quickly to geopolitical instability. Investors tend to pull money out of uncertain regions, leading to currency fluctuations and capital flight. This further destabilizes economies already under stress. Governments may impose sanctions or trade restrictions which can isolate entire regions from global commerce and worsen shortages. Even countries not directly involved in the conflict feel the impact. A war in one region can ripple across the world, affecting industries and economies thousands of miles away. The result is a fragile global system where uncertainty replaces predictability, and the smooth functioning of trade is replaced by delays, inefficiencies, and rising costs. Oil sits at the center of the global economy, so when its price moves, everything else tends to follow. It's not just about fuel for cars. Oil is embedded in transportation, manufacturing, agriculture, and even packaging. When oil prices rise, the immediate effect is higher transportation costs. Trucks, ships, and airplanes all become more expensive to operate, and those added costs get passed along the supply chain. Businesses that rely on moving goods across long distances are hit first. Shipping companies raise their rates, airlines increase ticket prices, and logistics networks become more expensive to maintain. Retailers and manufacturers then adjust their pricing to protect margins, which leads to higher costs for consumers on everything from groceries to electronics. Agriculture is especially sensitive to oil price changes. Farming equipment runs on fuel, fertilizers are often petroleum-based, and transporting crops to markets requires energy. As oil prices climb, food production becomes more expensive, which directly contributes to rising grocery bills. There's also a psychological effect in the market. When oil prices surge, it signals potential instability, and businesses begin to anticipate further cost increases. This expectation alone can drive prices higher, as companies preemptively adjust energy costs also influence inflation at a broader level. Since nearly every industry depends on energy in some form, rising oil prices act like a domino effect, pushing up costs across the entire economy. What starts as a shift in one commodity quickly spreads into a widespread increase in the cost of living. Currency loses purchasing power most noticeably during prolonged crises because pressure builds from multiple directions at once. When economies face instability, whether from war, energy shocks, or financial stress, governments and central banks often respond by increasing the money supply to support growth and prevent collapse. While this can stabilize the system in the short term, it also means more money is circulating without a matching increase in goods and services. As a result, each unit of currency begins to buy less than before. Prices rise gradually at first, then more rapidly if the imbalance continues. What makes this especially dangerous is that the change is often subtle in the early stages. People may notice small increases in everyday expenses, but over time, those increases compound, significantly reducing purchasing power. Wages typically lag behind inflation. Even if incomes rise, they often fail to keep pace with the actual cost of living. This creates a gap where households feel financially squeezed despite earning more on paper. Savings are affected even more directly. Money held in cash or low-interest accounts steadily loses real value, meaning that what could once cover months of expenses may no longer be sufficient. Currency depreciation can also be amplified by loss of confidence. If investors in foreign markets begin to doubt the strength of an economy, they may reduce their holdings in that currency, causing it to weaken further. This makes imports more expensive, adding another layer of inflationary pressure. Over time, the combined effect erodes financial stability and reshapes how wealth is preserved and transferred. Governments often respond to economic stress by increasing the money supply, especially during periods of crisis when growth slows and unemployment rises. This process can take several forms, including stimulus spending, direct payments to citizens, and central bank policies that inject liquidity into financial systems. The goal is to keep businesses operating, support consumer spending, and prevent a deeper economic downturn. Central banks play a key role by lowering interest rates and purchasing financial assets such as government bonds. This effectively puts more money into circulation and makes borrowing cheaper. Businesses can access credit more easily, and consumers are encouraged to spend rather than save. In the short term, this can stabilize markets and restore confidence, which is why such measures are commonly used during recessions or financial shocks. However, increasing the money supply without a corresponding increase in productivity or output creates an imbalance. More money begins to chase the same amount of goods and services, which leads to rising prices. This is where inflation starts to take hold. While moderate inflation can be manageable, excessive money creation can accelerate the decline in purchasing power. There is also a long-term consequence tied to debt. Government spending during crises is often financed through borrowing, which increases national debt levels. As debt grows, maintaining economic stability becomes more challenging, and future policy options may become limited. The immediate relief provided by money creation can mask deeper structural issues, gradually shifting the burden into the future and weakening the overall value of the currency. Inflation has a subtle but powerful effect because it doesn't take money away directly. It reduces what that money can actually buy over time. At first, the changes seem small: a slight increase in grocery bills, higher fuel costs, a gradual rise in rent. These shifts often go unnoticed in isolation, but together they create a steady drain on financial stability. For individuals relying on savings, the impact is even more significant. Money kept in cash or low-yield accounts loses real value as prices increase. What once represented security and future purchasing power slowly weakens, especially if interest rates fail to keep up with inflation. Over time, this erosion compounds, making long-term financial goals harder to achieve. Fixed incomes are particularly vulnerable. People earning a stable salary or relying on pensions experience a tightening effect as their income remains relatively constant while expenses continue to rise. Even when adjustments are made, they often lag behind actual inflation, leaving a gap that reduces overall quality of life. Inflation also changes behavior. As people notice their money stretching less, they may cut back on spending, delay investments, or shift towards short-term decisions instead of long-term planning. This reaction can slow economic activity while simultaneously increasing financial stress at the household level. What makes inflation especially dangerous is its quiet nature. Unlike sudden financial shocks, it operates in the background, gradually reshaping purchasing power and diminishing the value of money without a clear starting point or immediate alarm. Economic downturns don't eliminate wealth as much as they redistribute it, often shifting it from those who are unprepared to those who are positioned to take advantage of changing conditions. When markets decline and uncertainty rises, asset prices tend to fall, sometimes below their intrinsic value. For individuals who lack liquidity or are heavily leveraged, this creates pressure to sell at unfavorable prices just to cover expenses or reduce risk exposure. At the same time, those with available capital and a long-term perspective see opportunity where others see fear. They are able to purchase quality assets, stocks, real estate, or businesses at discounted prices. This difference in positioning creates a widening gap over time, as assets acquired during downturns often recover and grow in value once stability returns. Behavior plays a major role in this shift. Panic selling, emotional decision-making, and short-term thinking tend to dominate during crises. Many individuals move out of investments after losses have already occurred, locking in those losses instead of allowing time for recovery. In contrast, disciplined investors remain focused on underlying value rather than temporary market conditions. Access to information and financial education also influences outcomes. Those who understand how cycles work are less likely to react impulsively and more likely to act strategically. Meanwhile, others may misinterpret volatility as permanent decline, leading to decisions that weaken their financial position. Over time, these patterns repeat across different crises, gradually concentrating wealth among those who are prepared, patient, and able to act when others cannot. Energy dependency creates structural vulnerability within an economy because it ties growth, stability, and cost structures to a resource that is often controlled by external forces. Most modern economies rely heavily on imported energy, particularly oil and natural gas, to power transportation, industry, and infrastructure. When a country depends on external suppliers, it loses a degree of control over pricing and availability, making it highly sensitive to geopolitical events and market fluctuations. When disruptions occur, whether due to conflict, trade restrictions, or production cuts, energy supply can tighten quickly. This leads to sudden price increases that ripple across the entire economy. Industries that rely on energy-intensive processes face rising operational costs, which reduces profitability and can slow production. At the same time, higher energy costs push up expenses for households, affecting everything from heating and electricity to fuel for daily commuting. This dependency also limits policy flexibility. Governments may be forced to make economic or political concessions to maintain stable energy supplies, which can influence trade decisions and international relations. In some cases, countries may subsidize energy costs to protect consumers, placing additional strain on public finances. Efforts to transition toward alternative energy sources can reduce this vulnerability, but such transitions require time, investment, and infrastructure changes. Until then, economies remain exposed to external shocks. Even small disruptions in global energy markets can create outsized effects domestically, amplifying inflationary pressure and weakening overall economic resilience.